We're now going to look at some of the finer points of consolidation. I should mention right from the outset that some of these finer points are very unlikely to be tested. So those areas that I think are very unlikely to be tested, I'm going to ask you to look at on your own because I don't want to waste class time on them. If you're strained for time, I wouldn't worry about the areas that I think are unlikely to be tested. If you have the time and you want to study things that are even remote, very unlikely to be tested, by all means read those sections. But I'll spend class time on areas that I think are more likely to be tested, unless they're self-explanatory, in which case I'll ask you to read them on your own. So I'm going to point out to you those areas that are very unlikely, and I will not go over them. Those areas that are more likely to be tested, if I can add value, I will go over them. Otherwise, I'll ask you to read them on your own. Let's start off with determining the cost of acquisition. Let's start off with determining the cost of purchase to the acquirer company. The purchase cost is based upon the consideration transferred by the acquirer to the owner of the acquiring. So we said before that in calculating goodwill, we always have to take into account the consideration paid, because we take the consideration paid plus the non-controlling interest, and then we subtract the net value of the assets of the sub in coming up with goodwill. So how we measure consideration is going to have a huge impact on the value of the goodwill. So how do we value consideration? So the consideration that the acquirer pays for the acquirer, we value at fair value. There's different types of consideration. The acquirer might give up an asset to buy the acquirer. They may give up cash or some other asset. The acquirer may issue a liability. They may issue debt, for example, to acquire the acquiree. They may issue an equity instrument. For example, they may issue shares in order to acquire the acquiree. And then finally, there could be contingent consideration. Contingent consideration is where A buys B, and they agree that if a certain condition is met, they'll pay additional consideration. That would be an example of contingent consideration. I don't think contingent consideration is very likely to come up on an exam because it's fairly sophisticated. So at the end of the day, what we would do is, regardless of the consideration used, we generally value the consideration based on fair value. So if I give up a piece of land, if A gives up a piece of land to buy B, we would value the land based on the land's fair value. Now, what happens if the fair value is different than the carrying value? We're always measuring consideration based on fair value. In many instances, it's going to be different than the carrying value. If the transferred asset or liability has a carrying value that's different from fair value, then what we would do is we would remeasure that item at fair value with any difference recognized in profit or loss. We would do that before accounting for the investment. So let me just give you an example to explain what I mean. Say company A purchases company B, and they use a piece of land for the acquisition. Company A gives the shareholders of B a piece of land in return for their shares. Say the land had a book value, which is the same thing as carrying value, of $80 million, and a fair value of $100 million. So the consideration is going to be valued at fair value. So the consideration for the acquisition is $100 million. But given that the book value of the land was only $80 million, the carrying value was only $80 million, book and carry mean the same thing. Before we can account for the investment in company B, company A first has to do the following entry. They have to adjust the value from 80 million to 100 million by debiting the land 20 million, and that brings it up from 80 to 100, and the credit would be to the income statement. The credit would be to a gain. Then you would have the actual acquisition entry where A would debit investment 100 million, which is the fair value of the consideration, and credit the land 100 million. As we said earlier, when it comes time to consolidate, they're going to have to remove this investment from the balance sheet and also remove the sub's equity accounts. Any equity instruments that are issued, say A issues shares in order to buy B, we would always base again on fair value on the date of the acquisition. If the equity instrument is listed in a public market, it trades publicly, then generally we would look at the quoted market price on the date of the acquisition in order to come up with the fair value. So if a publicly traded company, Bank of Montreal, issues shares to buy another bank, we would value the shares based on what they traded at on the date of acquisition. If a private company issues shares to buy another company, we'd have to do a business valuation in order to know the value of the shares. Measurement and recognition of assets acquired. Identifiable assets acquired and liabilities assumed, as I mentioned before, are normally measured at the acquisition date values. So at the date of acquisition, we would normally adjust the sub's assets and liabilities to their fair value. However, I mentioned earlier that there are a few exceptions to the rule. So let's take a look at what are the exceptions to the rule. Let's take a look. I'd like to start with an exception to the recognition principle. There are some exceptions in terms of measurement where we don't use fair value, but there's also an exception with regard to measurement. I'm going to start with an exception regarding measurement, and then we'll take a look at exceptions to the measurement rule, exception to using fair value. An example, or the primary example of an exception to the recognition principle is contingent liabilities. As I'm sure you're all aware, normally a contingent liability is only recognized under IFRS if it's likely that there will be an outflow of resources, or under it is only recognized under IFRS if it's probable that there will be an outflow of resources, and only recognized under ASPE if it's likely that there will be an outflow of resources. And again, there is a separate lecture on contingent liabilities, which you can look to for further discussion of this. That's the norm when you're dealing with a contingent liability. Things are a little different when it comes to consolidation. When it comes to consolidations, you would recognize a contingent liability as long as there's a present obligation that arises from past events, even if it's not probable that there will be an outflow, and as long as we can measure its fair value. So what I am saying is the following. Let's say the sub has a contingent liability. At the date of acquisition, the sub has a contingent liability. There's a lawsuit against the sub. Now, that contingent liability might not even be sitting on the sub's balance sheet because there's only a 30% chance that the sub will lose the lawsuit. So it's not sitting on the sub's balance sheet. For consolidation purposes, we would include the liability on the consolidated balance sheet, even though there's only a 30% chance the company will lose, and it's not probable there'll be an outflow. There's a 70% chance they won't be an outflow. Nevertheless, for consolidation purposes, we would pick up the fair value of the contingent liability as long as we can reliably measure it. So as long as we can come up with a reliable measurement of that value of that lawsuit liability, we would set it up in the consolidated statements, even though there's only a 30% chance that there will be an outflow. Now, you would not be expected to know how to value the contingent liability. That would be beyond your scope. You would just simply need to realize that for consolidation purposes, we would recognize a contingent liability even though it's not probable that the lawsuit will be lost. Now, I mentioned earlier that at the date of acquisition, we would value the sub's assets based on their fair value. And I then went on to say, with a few exceptions. Now I can finally tell you what those exceptions are. Number one, when you're dealing with income taxes, okay, bottom line is any balance sheet item for income taxes, could be an asset or a liability, employer future benefits. For both of these items, rather than using fair value, we would use the carrying value based on the respective handbook sections. Another example, another exception to the measurement principle would be assets held for sale. In the case of assets held for sale, rather than using fair value, we would measure them at fair value less cost to sell. That is the general rule of how you measure assets held for sale at carrying value. For assets held for sale, carrying value is based on fair value less cost to sell. We would use that same figure for consolidation purposes. So rather than using fair value, we would use fair value less cost to sell. Indemnification asset, unlikely to come up on the exam, so I'll let you look at it on your own. I can't promise you with 100% probability it won't come up, but it's unlikely, so I'd rather not go over this in class. But if you want to be 100% certain, you're more than welcome to look at it on your own. Measurement period is a very important concept that it's important you understand. The best way to explain measurement period is not to read through all the mumbo jumbo you see in front of you. Let me explain to you the basic concept. And as long as you understand the basic concept, you don't have to read every word in the notes on measurement period. What exactly is a measurement period? Let me explain. Let's say company A purchases company B. And let's say company A is a big company and so is company B. Let's say company A is a high-tech company and they buy another big high-tech company. Let's assume the year end is December 31st and the acquisition, for example, takes place in mid-November. Company A, the acquirer, is a public company and they want to have their statements out a month after year end. So if their year end is December 31st, by January 31st, they want their statements out. The acquisition took place November 15th, a month and a half before year end, another month after year end to prepare the statements. So there's only 2.5 months from the date of acquisition to prepare the financial statements. If this is a big complex acquisition, what are the chances that in 2.5 months, company A will be able to do an appraisal of all of B's assets, including their land? Let's say B is a high-tech company. They may have all sorts of research projects and development projects that will have to be valued. What are the chances that company A will be able to do an accurate valuation of all of B's assets in only 2.5 months? This is where measurement period comes in. The measurement period provides the acquirer with a reasonable time to obtain the information it needs to do an accurate measure. So here's how we would work the measurement period. We would say to company A, if by January 31st, when you want to get your statements out, you didn't have enough time to do an accurate valuation of all of these assets, you didn't have time to get accurate appraisals of their land, accurate valuations of their development projects, what we're going to do is the following. We'll let you do your financial statements for the year of acquisition based on whatever values you were able to come up with, whatever estimates you were able to come up with. And then you've got the measurement period. We will then give you more time after year end or even after January 31st to come up with better values, to finish your appraisals and finish your accurate valuation of all of the subs assets. That period that we give you to come up with more accurate valuations, that is referred to as the measurement period. The measurement period ends as soon as the acquirer gets all of the information they need to do accurate valuations, or they reach the point where they know they're not going to be getting any more information. So, for example, let's say the acquisition took place on November 15th, excuse me, of year one. Okay. Let's say it's going to take them a number of months. It'll take them until, I'm just making up a date here, until August of year two to accurately value all of the assets. The measurement period would stretch all the way from the date of acquisition, November 15th, year one, until August of year two. Let's say they have all their information by August 15th of year two. The measurement period would end August 15th of year two. Now, what this means is the following. At the end of year one, the company would put out financial statements. based on the best estimates they can come up with. Then finally, at the end of the measurement period, when they finally have accurate valuations in place, they would then go back and retroactively adjust their year one financial statements. Now, the longest a measurement period can be is a year after the acquisition. You can never have an acquisition a measurement period longer than a year. So the longest we would give the company to come up with accurate valuations would be till November of year two. By that point, the measurement period ends. So they've got up to a year to come up with good valuations. If they're able to come up with good valuations before the end of the year, then the measurement period would be shorter. But during the measurement period, they can go back and retroactively adjust the financial statements. Because they're allowed to retroactively adjust the financial statements of year one, in the year one financial statements, they would have to warn the users in the notes that the statements may be subject to adjustment, that they may be retroactively adjusted. That is the basic gist of measurement period. I hope that was clear. Goodwill. Conceptually, goodwill is the excess of the fair value of an acquired enterprise over the amount assigned to the net assets of the company acquired. So if A buys 100% of B for $1 million, let's assume that none of the exceptions exist, so all the sub's assets are at fair value, and the net assets of the sub are $900,000, and the company paid $1 million. We would assume the goodwill is $1 million minus 900, which is 100,000. The company was willing, the acquiring company was willing to pay an extra 100K above the value of the net assets because of goodwill. Now, in allocating the purchase price, we are not allowed to vary tangible and even intangible assets in goodwill. Under what conditions would I have to assign value to specific intangible assets rather than burying them in goodwill? Here are the two rules you need to be familiar with. An intangible asset has to be set up separate from goodwill rather than buried in goodwill if we meet either condition A or B. Let's take a look at A first. Condition A says that the asset results from contractual or other legal rights. So what we're saying here is if company A buys company B, say company A has, company B, the sub has an operating lease with favorable terms, or a license, or a patent. These are all legal rights. So we would have to figure out the fair value of these legal rights. They can't be buried in goodwill. They would have to be set out separately in the balance sheet under the heading of intangible. So if condition A is met, we're dealing with a legal right. It has to be set up separately as an intangible. Or if we meet condition B. Condition B would be we're dealing with an item that is not a legal right, but it is capable of being separated or divided from the acquired enterprise and sold, transferred, licensed, rented, or exchanged. What I mean is the following. I'm not going to read these paragraphs. I'm just going to explain them. If company A goes out and buys company B, company B, for example, has a customer list. A customer list does not meet condition A because it's not a legal right. Now, as long as the sub would be able to sell that customer list or rent or lease that customer list, so the customer list could be separated from the sub, we would have to attribute a value to that customer list and set it up as an intangible. Now, here's a very important principle. When we ask ourselves whether we need to set up a separate intangible or not, we don't look at the specific behavior of the sub in question. If A buys sub B and sub B owns a customer list that normally companies would rent or sell, but company B has a policy, we never sell or rent our customer list. That doesn't matter. What matters is it the type of intangible, in this case a customer list, that companies in general would sell or rent? If the answer is yes, we set it up as an intangible regardless of the behavior of this particular sub. I hope that's clear to everybody.